Welcome to a review of Home Industries. On the left I have the data and on the right my working spreadsheet. Let's go through the items one by one and see where we put them and how we conclude this. Alright, so I'm kind of jumping straight in here to the sales totaling 69,800. I'm just going to highlight these as we go down, and you can see I've put that in the sales box over here. Alright, 60% of those were on credit while the rest were on cash. So credit and cash sales both get listed as sales. The important part here is that this 60% is relevant to us when we calculate debtors shortly. So I'm just going to make it another color as it represents a balance sheet item. Alright, next up in my income statement is the cost of sales. So I'm going to look at the data that's provided for this, and they tell us here that, let me go back to my yellow highlighter, that we have an opening stock number and we have a closing stock. All right, and we made some purchases and that amounted to that number there. Okay, so those are the three pieces that you need to calculate the cost of sales. I did this calculation over here, and essentially this formula is opening stock plus purchases minus closing stock. So I've just substituted these numbers in here, opening stock plus purchases minus closing stock. That tells you everything that you sold during this time period, and there it is, the 30,014. Sales minus cost of sales will get us a GP. All right, now we're heading to find some expenses. Okay, so I don't know where these are. I'm going to go and hunt around. Here we go. 2.5% is marketing cost, 2.5% of sales. That's that calculation. The staff costs here were 8% of sales. That's to get that number there. And then general and admin totaled 2,704. Let's plug that number in. There we go. All right, moving down, there's something about some fixed assets. A patent was registered. I'm looking for that one next because that's next in my grid. Patent was registered and bought for a value of 10,000. All right, so that 10,000 relates to a balance sheet. All right, it was agreed that this would be amortized over a straight line period over 5 years. All right, so 10 divided by 5 will get you a amortization of 2,000 per year. All right, and that's what got us that 2,000. Its book value at the end of 1999 was 8,000, and we are in the year 2000, so it's going to be 6,000 on our balance sheet. By the way, what I should have done, just to be kind of strictly accurate, is maybe the highlighting there should be in yellow, because that's what drives the income statement number. Okay. Alright, so I'm still looking for some depreciation charges, and here they gave it to us. They said here the net fixed assets of 99 was 36,800. There's been no additional purchases. Depreciation was charged at 3,700. Okay, so we take that number and we plug it in there. Add up the expenses to get the total expenses, subtract them from the gross profit, it gets you operating profit. There is a interest expense, plug that in. There's a tax rate, let's use that. And we need a dividend, need something about dividends. Let's see what they say here. Oh, Christmas shopping. Friend deducted 3,500 from the company to do his Christmas shopping and asked to be treated as a dividend. Alright, so we plug those numbers in. The tax number we calculate, 30% of the profit before tax. Subtract those and we end up at a retained earnings of 12,378. Alright. So follow the grid, and from the end of the income statement we head over to the balance sheet. So let's do that. Head over here. Let's start with the ordinary shares. So we need to go hunting to find some information about the ordinary shares, and let's get out our green here. Authorized share capital of 100,000 Rand, issued shares. So they only issued 6,000 shares at 1 Rand each. Okay, so there we go, that's that number. Share premium, there's nothing in the first year, that comes in the second year. then the retained earnings is cumulative. So they gave us a number, and when I find it, I'll tell you what it is. There it is. Retained profits carried forward from 1999 were 8967. So just notice what I did here in the grid. I added this 1999 here, and I showed you where that retained earnings number would be. And now I'm adding the profits that come out of the income statement, and I'm putting it in there to get the retained earnings. I'm adding these to get the total equity, and then I'm hunting for a debt number, and that was a loan from long-term loan. Here we go, from his mother, 10,000. Nice mom. Okay, so here we've got equity plus debt gives us total capital. Take the total capital, copy and paste down the bottom. Must balance. Okay, let's go to the fixed assets. Right, where was the fixed assets number? It's probably sitting right in front of me here. And okay, there we go. Net fixed assets for 1999 was 36,800. There'd be no additions, and we have to subtract depreciation. So take the 36,800 minus 37. That gets you the net book value. Great. Then the patent, we agreed that in 1999 it was 8,000. There it is. We must amortize it down to 6,000. All right. Stock 2501. We've used that number already in our cost of sales calculation. Debtors. Okay, we've got to do a little calculation here. All right, so what's the nature of debtors? Here it says 60% of our sales are on credit. So we've got to take 60% of 69,800. That will get us our credit sales. We're going to divide that by 365, and then customers on credit are taking 27 days to pay us. All right, divide it by 365 and times it by 27, and you will get the debtors number. All right. So cash was given. Is that right? Cash on hand. There we go. Take that number, plug it in. Creditors was given. Take that number, plug it in. And we are left with the cash book showed the company was overdrawn, but the exact amount still had to be reconciled. So right down here, we have to do a little calculation to work that out. Okay, so we know that the net assets is equal to fixed assets plus the patent. Put these two together, don't leave them out, put them together. This is going to be our FA if you want. Fixed assets plus current assets minus current liabilities. Plug those numbers in to the formula, all right? You don't know what the current liabilities are. You only know, let me write this here so you can see it rather than listen to me. NA equals FA plus CA minus CL. Right, that's the guiding principle. NA, we've got it. There it is. Fixed assets we've got. We're going to use those. CA we've got. There it is. The part we don't have is CL because we're missing the overdraft. So plug in what you've got, solve for CL. Once you've got the CL, then subtract out the creditors and you'll be left with the overdraft. And there we've completed the 2000 year for home industries. Let's move straight on to the next year. Back to the income statement. All right, bit of a story here going on. Is this tender that's coming into the picture. The tender would cause the turnover to increase by 75%. So you're going to take last year and you're going to grow it by 75%. Great, and that's going to get us this number here, which is 122,150. Great. The creditors, sorry, not the creditors, the credit sales portion has gone up to 80%. So we're selling more on credit. That's going to affect our debtors. I'm not going to use that now. I'm simply going to go on to the cost of sales and look for some information here. Due to the increased orders from suppliers, cost of purchases would be cut and predicted that the cost of sales would be kept to 40% of sales. Well, that's nice of them. So what they're doing here is they're simply saying that is 40% of sales. So take the sales number and multiply it by 40% and you've got a cost of sales. Subtract that to get a GP. Now let's head on. Let's go and find some marketing costs. Here we're just going to hunt these guys down. 5% over there for marketing. We've got some staff costs over there. What else do we need to address here? We've got to looking for some general and admin, kind of buried in here somewhere. That roll over onto the next page maybe. There we go, general and admin down there. We know the amortization cost is still in the business. That hasn't changed, so we can put the 2,000 in again. All right, and there's the depreciation expense. They've bought additional assets, all right, and as a result of buying these additional assets, the depreciation for the year has actually gone up. All right, that makes sense. More assets, more depreciation. Okay, so now we've got all of those expenses complete. Subtract them from your GP to get your profit. Interest paid. There it is. This number was given to us. Plug it in. What's next? Tax rate. They're probably saying tax remained unchanged. I'm guessing. Can't remember that exactly. Corporate tax rate was not due to change. Great. Okay, so we can use the 30% to get that. And then the dividend, 1/3. There we go. 1/3 of all these profits would be paid out as dividends. So take that number divided by 3 to get your dividend and subtract the dividend and you're left with 17,101. Fantastic. Take that number to the balance sheet. Let's head there. Take it to the balance sheet, add it to the existing. It's cumulative. All right, that takes care of the retained earnings. Next up, he's raising some capital here. And under the capital raise, there we go, it was agreed to issue Sydney with 6,000 ordinary shares to make him an equal partner in the company. However, due to the track record of the reputation established by George, it was agreed he would pay a 100% premium. In other words, instead of paying R1, he's paying R2 a share. R2 times 6,000 shares is 12,000 Rand. All right, so the share capital is going to go up from 6,000 to 18,000. The thing is, how do you allocate this? Now, this is in two parts. There's a share premium part and there's a par value component. So 6,000 times R1 gets added to the existing ordinary shares. And 6,000 times R1 premium goes in the share premium box. Add all of these to get the total equity. Something about extending the loan. George's mother offered him additional loan. That is so kind of him. So kind of her. All right, so there's the extra 20,000. This premium stuff here should have been in the right color because we're talking about balance sheet items. Okay. So there's the extra 20,000 loan over there. Equity plus debt gets total capital. Add these two together to get the total capital. Take that number and plug it in down there. All right, head on, fixed assets. So we've got to take the 33,100. We must add in the 42,000 of additional and then subtract out the depreciation to get to 67,000. The patent's easy, you just deduct the 2,000 again. And now we head on to the stock. Oh, I love the stock one because this causes all sorts of problems. Something about 8 times. There it is at the bottom here. Stock levels were expected to increase and it's predicted that the stock turn would be 8 times. So what you might be tempted to do is to take 2,501 and times it by 8. But that is 8 times more stock. I'm not talking about the turnover. The turnover of stock is the amount of times that you sell your stock in a year. So there's a formula for this, and that formula is cost of sales divided by stock is a stock turn. In other words, it's just saying if you take your total cost of sales for the year and divide it by the amount of stock that you have on hand, it's going to give you an indication of how many times you sell out your stock. All right, so in this case, 8 equals cost of sales over stock, and we're solving for stock. I'm going to leave it to you guys to do the algebra. That will get you to 6,108. All right, the debtors, was this not given to us? There it is, yeah. George is likely to take longer to pay his debtors, and they gave it to us, so we didn't have to do any calculations there. What we did have to do is we definitely had to calculate the cash. I think that's what it was hoped that increasing equity, there'll be no more debt. We'll not have to rely on overdraft funding. We're required to prepare the final accounts. What is the net cash position? All right, so we've got to calculate that. However, we still have to deal with the creditors. All right, we still have to deal with the creditors. Let's see, that is something about 29 days. Here we go, all the way back here at the top. In return for discounts from suppliers, they had to be paid sooner. This would be effective, bring the creditor days down to 29 days. So the formula is creditor days equals creditors divided by cost of sales times 365. Shortcut is you come and get the cost of sales. There it is, divided by 365. Then multiply by 29, that's just doing the algebra, and that will get you back to 3882. And then you have to solve for cash, and again we come back to this formula. We have the net assets, there it is. We have the fixed assets, use both of those. You have the current liabilities this time, what you are missing is the current assets. So plug the numbers in, solve for current assets, it gets you there. And once you've got that number, subtract the stock and subtract the debtors, and you will be left with the cash. Fantastic. That is the income statement complete. Let's head on to the cash flow statement. Alright, so here's the grid. Cash flow statement always starts with operating profit, so we go and hunt down that number. There it is, the 40,335. Put that into the cash flow statement. Add back depreciation. This is depreciation and amortization. It might not say that, but you've got to have both of them in there. All right, that gets you to the cash inflow. Okay, so this is operation sorted. Next, we're heading on to the working capital component. And here, we're going to go and get the differences in the balance sheet. Follow our rules. Let's see what our rules are. If stock goes up, cash goes down. If debtors goes up, cash goes down. If creditors goes down, cash goes down. Getting the difference between these in each case. Okay, plugging them in here. Now this looks to be incorrect. What's going on here? The balance sheet, we want that number, negative 1418. Cash flow statement equals balance sheet. All right, all of those are negative. Great. Purchase of fixed assets, that's also a negative, 42,000. That was given. Inflow of the loan, outflow of the interest. Okay, remember these are financing. This is investment activities. Shareholder activities, there's the 12,000 from the shareholders. There's the outflow in the dividends. There's the outflow in the tax. All right, so now this number here is going to be the sum of everything here. Make sure you have your signs in, so you just sum it up. It will do the calculation for you. All right, that gets us to the net position. Now, what's the opening position? Notice that this opening position is cash minus overdraft. That's what that is telling us, D21 minus D24. Let's go and have a look. There's D21 minus D24. We're getting the net position there as our opening cash. All right, to get the net position as the opening cash. Now, cash flow minus net cash at the beginning gets you the net closing position. Turns out there's no overdraft, so that matches the cash in the balance sheet exactly. Let's make sure. There it is. That's the number you've got to get to. Fantastic. All right. Okay, so I'm going to leave it there. You've got all the income statement, balance sheet numbers done for Home Industries.